In this case, I'm assuming that purchase price of the home is $750,000. So to buy a $750,000 home, the minimum down payment required is $50,000. For this example, I'm assuming that we are putting 10% of the purchase price, that is $75,000. So on the basis of this minimum down payment, the mortgage default insurance would be around $20,925. So when you are putting less than 20% down, you have to incur the cost of mortgage default insurance. This insurance premium gets added to your mortgage required. So in this case, the total mortgage that we require is $695,925. Interest rate, I'm assuming it to be 5%. So when the interest rate is 5%, the minimum qualifying rate would be 7%. So as per the mortgage stress test, the lender makes you eligible on the rate that is 2% more than your actual contracted rate, or 5.25%, whichever is higher. So in this case, your qualifying payment would be around $4,874. Amortization, I'm keeping it 25 years. And for an insured mortgage, it cannot exceed 25 years. So monthly housing cost comprises of your property tax and minimum utilities, which a lender considers while approving your mortgage. And your actual mortgage payment, that is your principal plus interest payment for this mortgage, would be $4,047.53. So after inputting all these figures, this calculator is showing us that the minimum income or the ideal income you require to buy this home of $750,000 with $75,000 of down payment for around $169,019. So I am assuming that we have the same income. So I'm just rounding off to the next number. I'm putting $169,100. So just have a look over here under the GDS, that is gross debt service ratio. So a lender calculates your eligibility on the basis of two major ratios. One is GDS, that is gross debt service ratio. So the GDS ratio includes your monthly housing cost, which includes your mortgage payment, your property taxes, your heating, or 50% of the condo fee if you are buying a condominium. So as per the mortgage standards, your total monthly housing cost, that is GDS, should not be more than 39% of your gross household income. And particularly when it's an insured mortgage, that is where you are putting less than 20% down, it cannot exceed 39%, because the mortgage default insurance providers such as CMHC have set the limit that they will only be approving for the mortgage default insurance where the GDS is less than 39%. So now with this income, we are good with the GDS since it is lesser than 39%. Now let's come to the second important ratio, that is TDS, which is total debt service ratio. So as per the mortgage standards, your total monthly debt should not be more than 44% of your gross income. So what TDS includes? It includes all of your housing costs, including your mortgage, utilities, property taxes, and on above of that, whatever your car loans, your credit card balances, lines of credit, student loans, or any other debt you have, combining all these debts, it should not be more than 44% of your annual gross household income. So now in this case, it is sitting at 38.98%. It means even if we have any monthly debt payment, we can still be getting approved for this mortgage of $695,925. Let's assume in this case that you have a car loan payment of $500 a month. So under the monthly debt, I'm going to input $500. So even after putting $500, the TDS is coming out to be 42.53%, which is well within the mortgage standards, that is 44%. So this example proves that if you are going for an insured mortgage, even if you have a monthly debt, or as per this example, a car loan of up to $500, you can still be getting approved for a mortgage. But here I just want to give you a heads up. Although as per the mortgage standard, you will be getting approved for a mortgage because your ratios are below the mortgage standards. But a higher TDS ratio means you are increasing the risk of taking on more debt that you can afford. Always keep yourself well below your maximum limits. Never stretch yourself to the maximum what you can get approved for. Because in the future, your housing costs can increase with the increase in the property tax in future, with the utilities or other repair and maintenance that you will be undertaking for the property. So where you are putting at least 20% down, it is called a conventional mortgage. So here in the down payment, I am assuming that we are putting actually 20% down, that is $150,000. So now see, with $150,000, there is no mortgage default insurance premium that you need to pay. And the mortgage that you require to buy this home is $600,000. I'm keeping the interest rate and the amortization as it is as per the last example. So now with the only change in the down payment, you can see the ideal income that we need to buy this home is $148,346. For this example, I'm assuming that we don't have that much of income. And let's suppose that our household income is $140,000. So I'm going to input here $140,000. So now if you can just come down here and look at the GDS. So GDS is 41.32%. Cannot be more than 39% in case it's an insured mortgage. But when you are putting 20% or more than 20% down, in that case, a lender may still qualify you for a mortgage, even if your GDS ratio is slightly higher. Again, mentioning here, a higher GDS ratio means you are increasing the risk of taking on more debt than you can afford. But if you're stretching yourself to the maximum of your budget, then it can happen. Now we take the same example as previous, that we are having a $500 of car loan payment. So I'll just input $500 over here. Just have a look at the TDS. Now with this $500 of monthly car loan payment, the TDS is now surpassing 44%. In this case, it is coming out to be 45.61%, which is going above the mortgage standard of 44%. And even the lender might not be comfortable to approve $600,000 of mortgage with this higher TDS. What's going to happen in this case? So two scenarios can happen. First, the lender will be approving you with the lesser of the mortgage if your annual income is going to stay as it is. So if I'm keeping my down payment the same, which means I have to reduce my purchase price. So I'm just reducing my purchase price by $30,000 to $720,000, for which now the mortgage that we require is $570,000. So now if you see, with the reduced amount of the mortgage, the TDS is coming well within the standards, that is 44%. Now you can get approved for this mortgage of $570,000, which means a car loan of $500 has now reduced your borrowing capacity by $30,000 in this case. Or we can take the other scenario. If you still want to buy a house of $750,000, what you need to do is you need to increase your down payment. So from $150,000, at least you have to put $180,000 so that the mortgage required can come down to $570,000. So in a conventional mortgage, where you are stretching yourself to the maximum of your limits, a car loan payment can actually affect your eligibility to get a mortgage. So as soon as I enter the annual household income, this calculator is already showing what can be the maximum purchase price and how much minimum down payment we need to put. So since this example based upon 20% minimum down payment, so I am putting $227,000 to be the down payment. Interest rate taken for this example is 5.29%. So I'll put over here. Amortization, I'll keep it 25 years. Property tax taken for this example is $4,000 per annum. So I'm taking $350 per month. Utilities have been considered to be $150. So after inputting all this data, this calculator is showing us that an average price of a home in Toronto is around $1.09 million, where the debt service ratios are also within the mortgage standards, that is 39%. In this video, I'm going to show you 5 effective and simple ways with which not only you can pay off your mortgage sooner, but can also save thousands of dollars of interest over the life of your mortgage. With the help of my advanced mortgage amortization schedule, you will see right in front of you how every dollar paid on and above of your mortgage payment can help you to save interest in the longer run. So without wasting any time, let's get right into it. So this calculator is very easy to use. In the left-hand column, if you see, we just need to enter the values. For this example, I'm assuming we have a mortgage of $525,000 at the interest rate of 5%. Amortization I'm selecting as 25 years. For a term of 3 years, I'm assuming it to be 3-year fixed loan. So for this amount of the loan, your monthly payment is going to be $3,053.43. And at this interest rate, what is the total interest that you're going to pay over the lifetime of the mortgage? It's around $391,000. So the very first method is rounding off your payment. So in this example, your monthly payment is $3,053, which is close to $3,100. So what you can do is you can just round it off to $3,100 if you can. So difference is around $47, which means with every monthly payment, $47 on and above of your mortgage payment will be added to your principal balance. So here I have already inputted $47. Payment interval means the frequency that we want to set for this extra payment. So since we want to pay it with every monthly payment, so I'm just inputting 1 over here, which means now instead of $3,053, each month we are going to pay a round figure of $3,100. And by rounding off your monthly payment to $3,100, total interest saving over the period of mortgage will be around $13,229. And here, if you look at the number of payments, it has reduced by 8 payments, which means you will be able to pay off this 25 years mortgage 8 months before. So see, just by rounding off your mortgage payment, you can save this much of interest. Now let's move to the second effective method to pay down your mortgage early, which is converting your monthly payment to accelerated bi-weekly payments. We also call it as the rapid bi-weekly or weekly payment. Here, I would just like to clear the difference between a bi-weekly and a rapid bi-weekly payment. In a bi-weekly payment, you are not paying anything extra. Over the total payments you are supposed to make in 1 year, that are just divided by 26 equal payments. But in accelerated bi-weekly or the rapid bi-weekly payments, you make one monthly extra payment in 1 year, which helps you to pay down your mortgage faster in the longer run. How? Let's see with this example. So as soon as I select accelerated bi-weekly over here, so just have a look now, your payment would be $1,526.71. So by changing this payment frequency, interest saving is $62,442. And just have a look over here. You will be able to pay off your mortgage around 3.5 years early as compared to 25 years. So just have a look what a bigger impact changing your payment frequency has in saving you thousands of dollars of interest. Now here, if you can just make one smart move and bring in the previous method that we discussed in this one as well, like rounding off your mortgage payments, it will have further interest savings for you in the lifetime of the mortgage. How? Let's see with this example. So now accelerated bi-weekly payment is $1,526. If you further round it off to $1,600, let's see what the impact is going to be. $1,600 means you will be paying additional $74 with each bi-weekly payment. So I'm going to put $74 in the interval since we will be paying with each payment. So I'm putting 1 over here. So the interest savings, which previously was $62,000 with changing the frequency, have now increased to around $91,654 by further rounding of the payment to $1,600 bi-weekly. So if you can club both these things, it will have further savings. And just have a look here. What will be the time saving over here? The 25 years mortgage will be paid off in lesser than 20 years. Now let's jump to the third simple and effective method to pay off your mortgage. That is to make one extra monthly payment in each quarter. Let me show you how impactful it will be to pay off your mortgage earlier. So I'll just put here $3,053. So we have to pay this payment after 3 months, that is quarterly. So I'm putting over here 3. So if I just show you here in the amortization schedule, so this table has automatically applied this $3,053 payment after every 3 months automatically. So if you make one monthly payment extra after 3 months, the interest that you are going to save on this mortgage is $164,159. And you will be able to pay off your mortgage in 15.5 years as compared to 25 years. So if you want to pay off your mortgage as early as possible, this is one of the fastest way with which you can be mortgage free. Now let's move to the fourth method, that is to make occasional lump sum payments to your mortgage. So every lender provides you with some prepayment privilege with which you are allowed to make certain prepayments in 1 year towards the principal of your mortgage. Most of us get some unexpected income in a year, whether it's any monetary gift or profit, or whether it's a bonus that you get from your employer. So what you can do is, you can apply some of these unexpected income towards prepaying your mortgage. So let's take an example in this case that person receives a bonus of $8,000 each year from his employer. He decides to apply $5,000 out of those $8,000 towards prepaying his mortgage each year. So what I'm going to do is, under extra annual payment, because he has decided to pay each year a fixed amount, that is $5,000, I'm just going to put this amount. As soon as I put this amount, so just see here under the extra payments column, this table has automatically integrated $5,000 at the end of every 12th payment. So with this annual payment, the total interest savings would be $87,626. And this mortgage can be paid 5 years early, that is in 20 years. If you don't want to commit a fixed amount each year, what you can do is, you can just remove the amount from here. And here under the additional payment, let's suppose you have plans to put $5,000 on a particular date. You can just simply put amount over there as a one-time payment. And simultaneously, you can here see with this chart how much interest savings would be there with each extra payment that you are putting as a lump sum. Now, the last and the final method to pay off your mortgage early is take a mortgage for the shorter amortization period, or if you have an existing mortgage, refinance it to shorter term. The effect of shorter amortization period would be, you'll be having larger regular payments, But due to larger regular payments, the interests that you'll be paying over the lifetime of the mortgage will be lesser. So if you see for this $525,000 mortgage for 25 years, the total interest you would be paying over the lifetime of the mortgage is $391,026. But if you just take this mortgage for 20 years, or if you have this existing mortgage refinance into 20 years, this total interest that you'll be paying in the lifetime of the mortgage is around $302,976, which means a saving of around $88,000 of interest. So these were the 5 most effective and the simplest way with which you can plan to pay down your mortgage effectively in the longer run. You can also use this advanced mortgage amortization schedule for your mortgage to see what will be the impact on the total interest savings if you apply one or more than one methods collectively. I'm providing the link of this planner in the description of this video. And if you like this video, do subscribe to this channel for more knowledgeable content in the future as well. Thank you.